Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We're diving into a week that honestly felt fundamentally bipolar, really split down the middle.
Yeah, definitely.
On one side, you had these huge geopolitical tensions driving massive volatility, whiplash, really.
Hmm.
But then, quieter, almost hidden, was this domestic failure in private finance, exposed some, well, structural weakness.
Right.
So our mission today is pretty simple. Let's try to filter out the noise, pull out four crucial, durable insights you can actually use, especially thinking long-term about the U.S. dollar.
And it was certainly a dramatic end to the week, Friday, October 10th. I mean, it felt like 2020 volatility came roaring back for a day.
It really did.
We saw that the S&P 500 drop was at 2.7%, and the NASDAQ, the tech benchmark, fell even harder, 3.6%.
Oh.
That was the biggest single-day percentage drop in about 6 months.
Oh.
A real shock to the system.
And the trigger, it seemed, was just pure sudden policy, an escalation out of almost nowhere.
Yeah, President Trump openly threatening that massive, kind of unprecedented 100% tariff.
On all remaining Chinese imports. That's the key part. All of them.
And China didn't really blink, did they? They fired back almost instantly, tightening controls on rare earth exports.
Which people need to remember, those rare earths, they're critical for everything from fighter jets to, your new EV.
Exactly. And that abrupt policy threat, it just immediately flips the market's risk-off switch. Just bam.
Okay.
And the best place, really, to see that switch flipping violently is the VIX, the volatility index.
Right, the VIX, the fear index, as they call it. It spiked. Highest level all year.
Right.
Now, for people who track it, they talk about options pricing, but maybe in simpler terms. What's the VIX actually telling us when it surges that fast?
It's basically the market's best guess, the institutional guess, for how volatile things might get over the next 30 days.
Okay.
So when the VIX jumps like that, it signals a sudden massive rush for hedging, for insurance. Investors are scrambling to buy protection, buying defensive puts, other instruments, basically trying to shield their portfolios. They're willing to pay a huge premium, really, to protect against that worst-case 100% tariff scenario.
Okay, wait, let me just push back on that for a second. So you're saying a massive sell-off, right? Triggered by maybe the most extreme tariff threat we've seen. That's actually a preliminary buying signal. That sounds, well, it sounds very contrarian.
It does sound contrarian, I get that. But historically, the market often distinguishes between different kinds of selling pressure.
Okay.
If the VIX is surging mainly because of options hedging, like we saw, it means investors are paying for protection, sure, but they haven't necessarily been forced to sell their actual stocks or assets yet.
Ah, okay, so they're bracing, not necessarily dumping.
Exactly. They're defensively posturing. The selling isn't driven by, say, systemic margin calls or outright panic liquidation, at least not yet.
So insight number one then is something like, the immediate floor, the bottom, is often found when the fear itself peaks.
Precisely. That's a great way to put it. A rapid VIX surge driven by options hedging often signals defensive posturing, not systemic failure, and can be a preliminary indicator of a short-term price floor. The initial shock often overshoots. So before the weekend, the thinking was kind of like, okay, maybe we get a Monday flush, the market settles, maybe bounces back a bit. Not because the big problem is fixed, but just because the peak fear had maybe passed.
And that leads perfectly into the whole geopolitical reality, doesn't it? Because that short-term floor idea, it kind of relies on sanity prevailing eventually.
Right.
But what we saw was maybe the highest stakes game of economic chicken we've seen in years.
Absolutely. The escalation was incredibly fast.
Yeah.
And frankly, terrifying. China first aimed those rare earth controls at, U.S. tech sectors.
Right.
But the U.S. response was the all-in bet. The 100% tariffs, yes, but also even stronger threats. Essential software export bans. I mean, that wasn't just trade anymore.
Yeah.
That felt like a move toward actually severing the relationship.
Decoupling. Yeah, global financial markets really felt like they were buckling under that pressure. Friday morning, it honestly looked like we were heading for a full-blown economic rupture.
But here's the critical lesson, I think, for investors trying to navigate this kind of era.
Okay.
Just as that fear, that panic, reached its absolute maximum, President Trump and President Xi had a, quote, productive phone call late Friday evening.
Right. The news broke late Friday, and the outcome was just this total reversal, a sudden temporary truce.
Complete turnaround. The 100% tariffs that were scheduled for November 1st delayed. The Chinese rare earth controls also delayed.
And they confirmed they'd meet face-to-face at APEC in Korea.
Yes. And this right here, this reveals our second crucial takeaway for today. Market volatility itself is now consciously being used as a form of leverage in these geopolitical negotiations.
Wow. Explain that a bit more.
Well, think about it. The administration used that extreme threat, the 100% tariff, to shock the markets. That created immense pressure, obviously, on Beijing, but also on domestic stakeholders here in the U.S.
Right, like big tech defense contractors.
Exactly. Think about the CEOs of major tech firms, major defense contractors. They immediately started screaming bloody murder about what a 100% tariff would do to their supply chains, their costs.
So the market panic we saw Friday, you're saying it wasn't just a side effect, it was maybe part of the plan? A tactic?
It's almost terrifying, but yes.
Uh-uh.
It looks like it was used as a premeditated tactical weapon. Use volatility to maximize the pain, force everyone to the table, push for a compromise, and then achieve this dramatic, but importantly, temporary de-escalation.
So the lesson is that the highest point of fear can, paradoxically, actually signal a sudden reprieve is coming.
It can, but, and this is a really critical warning, this insight comes with a huge caveat.
Okay.
The underlying structural conflicts. Tech supremacy, supply chain security, national security concerns, those are totally unresolved. This is just a pause, a deliberate strategic pause. That 100% tariff card, it's still very much on the table. Can we play it again?
Okay, so volatility as a tool. Got it. Now, speaking of structural risks, maybe ones hidden from view, let's pivot away from geopolitics for a moment and look at this ticking time bomb, maybe, that flared up right here. Domestic finance.
Right.
The spectacular failure of a company most people probably hadn't heard of, an auto parts maker called First Brands.
Yeah, this collapse is, I think, enormously significant because it's potentially the canary in the coal mine for the huge multi-trillion-dollar private credit market.
Right. This isn't your typical bank loan market. This is where big institutional money lives. Pension funds, sovereign wealth funds.
Exactly. And experts are already labeling this First Brands case as, well, pretty classic. A situation where the desperate search for yield led to basically greed trumping due diligence.
Okay, we know why the money rushed into private credit, chasing higher returns, chasing yield. But what were the sort of structural issues that made private credit such a honeypot, so ripe for a scandal like this?
Well, the environment was pretty simple for years, right?
Yeah.
Central banks kept interest rates near zero, rock bottom. So these massive pools of capital pensions, endowments, sovereign funds, they had to find returns higher than what safe public bonds or regulated banks were offering.
They were under pressure.
Huge pressure.
Yeah.
So they poured trillions into private credit, which is basically lending money directly to companies, often bypassing traditional banks and public markets. The key thing is the rules of public disclosure are far looser there.
Less transparency.
Much less. And funds were so eager, maybe desperate, to deploy all that capital sitting on the sidelines, they seem to have skipped over some basic safeguards. Basic homework, really.
And that desperation, that lack of maybe thorough homework, it showed up in this fake EBITDA controversy.
Yeah.
Can you break that down? What exactly was that accounting trick?
Okay, so EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's supposed to be a measure of a company's current operating profitability. It's cash flow generation, basically.
Right. Standard metric.
Standard metric. But First Brands apparently secured these massive loans by aggressively using something called add-backs.
Add-backs.
Yeah. Essentially, they included highly optimistic, purely anticipated future cost savings or synergies, things that hadn't happened yet, and frankly might never happen.
Uh-oh.
And they added them into their current profit figures, as if they'd already achieved them.
Okay, so let me try an analogy. If I were trying to get a personal loan, this would be like me telling the bank my income includes a huge Christmas bonus I might get next year.
Exactly.
And counting that as part of my current monthly income to qualify for a massive loan today.
That analogy makes the, well, alleged fraud painfully clear. It's precisely that.
And the lenders, these sophisticated private credit funds like Apollo was mentioned, they just looked the other way or didn't look closely enough.
That's the billion-dollar question, isn't it? Why did professional sophisticated funds apparently fall for it? It probably wasn't just poor accounting by the company. It seems like a symptom of a system where less regulation created this immense pressure to deploy capital quickly, get the money out the door.
Yeah. So they maybe prioritized the deal, the size, the name value of the fund doing the lending, over the messy, fundamental task of really kicking the tires, doing the due diligence on the actual company.
It appears that way. And now some of these funds are facing potentially billions in losses.
Now, people aren't calling this a 2008-style systemic risk. Not yet, anyway. But it definitely sounds like a crisis of confidence in that private market space. So what's the fundamental investment lesson here for people listening?
Yeah, I think the third crucial takeaway is this. In an era where we're likely to see more credit stress, more failures, both institutional and individual investors absolutely must scrutinize the due diligence process much more closely, especially for these non-transparent private assets. Don't just rely on the name value of the fund involved.
Back to basics, really.
Completely back to basics. Look under the hood. Now, maybe there's a silver lining. This crisis might actually highlight the relative stability and transparency of the public bond market, where rules generally can't be bent quite so easily. And for the more sophisticated investors out there, this probably signals a new hunting season, starting for distressed debt specialists. They'll be looking to buy up these suddenly cheap, troubled assets in the private sphere.
Okay, that structural risk, the failure of due diligence, is actually a perfect way to transition to our final segment. We're moving from private credit risk to sovereign credit risk, the big one.
Yeah.
We need to talk about the debasement trade.
This is arguably the biggest long-term paradigm shift affecting every single portfolio out there. The debasement trade basically is built on the view that the U.S. dollar, and crucially, U.S. government debt, will inevitably decline in real value over time.
Okay, decline in real value.
Which forces investors, logically, to seek out alternative stores of value, things that hold their worth better.
So what are the main drivers? What's putting this long-term pressure on the world's reserve currency? Seems like a huge claim.
Well, there are two core drivers, really. First is what you might call fiscal inflation, the sheer scale of U.S. national debt. It's surpassed $40 trillion now.
40 trillion.
And maybe more importantly, there seems to be zero political ability or even will in Washington to actually tackle it. That fuels long-term fear of dollar dilution, just printing more money to pay debts. Classic inflation risk.
Okay, so the debt burden is one. What's the second driver?
The second, and this is maybe newer but equally important, is the weaponization factor.
Weaponization of the dollar.
Yes. Post-2022, after the sanctions on Russia's central bank assets, central banks around the world had a realization. They saw that the dollar and the dollar system could potentially be turned into a political weapon by the U.S. government.
Right. If you fall out of favor, your reserves could be frozen or seized.
Exactly. And that realization, that fear, is powerful. It's actively driving central banks globally toward de-dollarization, reducing their reliance on the dollar.
Yeah.
And a huge move toward accumulating physical gold reserves instead.
Okay, that makes sense conceptually, but we need market proof. Is there recent evidence that this fear is actually impacting how money flows? Is capital really fleeing traditional U.S. debt?
Yes. The clearest, most recent sign. The failed U.S. 10-year and 30-year Treasury auctions just this past week.
Failed auctions. What does that mean exactly?
It means demand was extremely weak, far weaker than expected. Not enough buyers showed up at the offered interest rates. This is actually a monumental event.
Why a monumental?
Because it proves that even during stock market instability like we saw Friday, the market is no longer automatically viewing long-term U.S. government debt as the ultimate safe haven. That historical faith in its default-free status, its absolute safety, it's being fundamentally questioned now by major institutions.
So if the traditional safe haven long-term treasuries is now looking more like a risk asset itself, where's the money going instead?
It's flowing toward alternative sources of value, assets that theoretically can't be diluted by printing presses or easily weaponized politically.
Like what?
Well, look at gold. It's up over 25% year-to-date, hitting new records. And look at Bitcoin, up over 100% year-to-date. It's increasingly viewed, especially by some institutions, as a kind of digital gold.
Why digital gold?
Because of its mathematically fixed supply and its perceived political neutrality. It exists outside the traditional system.
Okay. So let's bring this home for the listener. If you're watching this, how do you actually restructure your portfolio? How do you defend against this potential long-term debasement? This feels like our fourth and final actionable insight.
Absolutely. The fourth insight is essentially this. You need to integrate physical and perhaps digital store of value assets to hedge against these long-term debasement risks. And alongside that, relentlessly prioritize companies that have pricing power.
Okay, let's break that down. Operationally, what does integrate store of value assets mean?
It could mean allocating, say, 5 to 10% of your portfolio to gold. Physical gold, or maybe a physically backed ETF. Gold has a, 5,000-year track record as a store of value through a thick and thin.
Right. Tried and tested.
Tried and tested. And then for those investors who are comfortable with the volatility, and it is volatile, maybe a small 1 to 3% exposure to Bitcoin, as a sort of cutting-edge digital hedge against central bank policies and potential dilution.
Okay, gold and maybe some Bitcoin. What about treasuries? Do we just abandon U.S. government debt completely?
No, not completely, but you have to be much more surgical, much more selective. The long-term treasuries, the 10-year, the 30-year notes, those now carry that duration risk, that debasement risk we talked about.
So avoid those.
Or at least view them as risk assets, not pure safety. Instead, consider using short-term treasuries, things like 3-month treasury bills, maybe out to 1 year.
Why short-term?
Because they offer stability. They currently offer a pretty good yield, actually, and they act as a safe, high-yield place to park cash without locking you into that long-term dilution risk. You get your principal back quickly.
Okay, so short-term treasuries for safety and yield. Finally, what about stocks? Equities. What kind of companies do well when inflation and currency debasement are the main threats?
Here, the key is pricing power. You absolutely must focus on ultra-high-quality companies that have the power to raise their prices without losing customers.
Exactly.
Think about companies with really strong moats, highly defensible near monopolies, like, say, Microsoft, or dominant consumer staples giants, like Coca-Cola.
Why them specifically?
Because they have such strong market positions, such strong brands, they can easily pass rising input costs from inflation, from currency issues, directly onto consumers. They raise their prices, and people still buy their products.
So they protect their profit margins in real terms.
Exactly. They maintain their real profitability even when the value of the dollar itself might be eroding underneath.
Okay. So this deep dive really showed us kind of two different worlds colliding this week. You had the short-term, tactical, maybe even intentional market shock used for political leverage in the U.S. China game, Brinkmanship.
Right.
And at the same time, this slower, more structural erosion of confidence. First, in the due diligence within private finance, like with First Brands. And second, maybe more worryingly, in the long-term status of U.S. government credit itself.
Yeah, it means investors need to be sort of nimble and tactical in the short term, watching these political games,
Right.
but also deeply defensive and strategic for the long term.
Right.
And that leads us, I think, to a final provocative thought for you, the listener, to consider.
Okay.
The First Brand scandal clearly exposed a failure of due diligence in supposedly sophisticated private markets. Now, given the sheer size of the U.S. national debt and those failing long-term treasury options we just discussed, could the next major crisis involve a similar failure of due diligence? But this time, regarding the ultimate safe asset U.S. government credit itself.
Why?
And if that confidence erodes further, will it force major institutions globally to lean even more heavily on things like gold and maybe even Bitcoin as the true default-free collateral of the future?
That is definitely something to mull over as you review your long-term strategy. Don't forget to subscribe and hit that like button.